then you're going to get a credit of about 70 cents, 77 cents, and then you would stop losing if it falls below the 166.67 here. So you can set yourself up to feel a little bit more comfortable if Tesla keeps falling, and if it jumps back up, you can get all the premium from your shares all the way up to 200. So this collar strategy can be a powerful strategy to help you when the stock is going down a lot, to kind of just minimize that downside. In this video, we're going to discuss four different type of trades that we can do on stocks like Tesla. We're going to use Tesla as a baseline, as a trade or a company that we can use as an example. So you can do this type of strategies, these four different strategies we're going to discuss in any type of stock that has options associated with it. But you really want to do it on stocks that have some implied volatility. Some ETFs just don't have enough implied volatility, enough action for this to be a really attractive strategy. But we're going to introduce four different strategies. We're going to talk about four different strategies. The first strategy we're going to talk about is it's called a cash secured put. The second strategy we're going to talk about is called a covered call. And the third strategy is something that a lot of people haven't heard of, but it's been out there for a long time. It's called a collar strategy. Collar strategy is just a covered call with a put attached to it. And then the fourth strategy is what we call here at the Dorian Trader the Bionic bull. It's selling a cash secured put and then taking some of those monies to be able to buy a call so that you can be bullish with the put that you sell and bullish with the call that you buy. So we're going to break down these four different strategies using Tesla. We believe Tesla is a good example to do this on because Tesla has been falling over the last month or so, and it could be a good stock to be bullish on. It could fall more, but a lot of people out there follow Tesla. Is one of the most popular stocks out there, and Tesla has a tendency to go up and down, mostly up over the last several years. So this could be a potential buying opportunity for you bulls out there for Tesla. So once again, we're just showing this as an example. This is not an endorsement, or it doesn't mean that you can only do these four different strategies on Tesla. You can do it on, once again, almost any stock out there that has options attached to it. All right, so let's take a look at Tesla using the Thinkorswim platform. We're just going to look at the chart here really quickly so you can kind of get an idea on where Tesla's been over the last month or so. So you can see this is a 1-year daily chart, and this is how much Tesla has fallen recently. It just came out with earnings about a couple of days before this video, and it's falling more after the earnings. So maybe it has some support around 180, or maybe it's going back down to the 152, which is the 12-month low. In this example, we're going to be betting that it has some support around the 180. So we're going to jump over to this TastyTrade platform here, and we're going to look at Tesla on this options chain, and we're going to break down the four different strategies that we discussed. So strategy number one is selling a cash secured put. So if you're okay with taking ownership of Tesla, you can sell the 180 strike. If you're okay with taking ownership at the strike price of 180, you can sell that put. And if you get the mid price, someone's going to pay you $930 for that. So your cost basis is going to be around 170, just below 171, 170. Okay. That's going to be your cost basis. So even though you have to purchase it at 180, you have the obligation, if you sell a put, you have the obligation to buy. You have the obligation to buy at the 180, but your cost basis is going to be under 171. So somewhere in this area here, you're going to have to buy Tesla. That's going to be your cost basis. TastyTrade is telling you that you have about a 65% chance to be able to win on this trade, at least something at expiration, which is in 49 days from now. So instead of just outright buying Tesla at the going price, if we went here and clicked on the buy to buy 100 shares of Tesla, we would have to spend about we're about to spend about $18,400. But if we sell that put at the 180, then we will spend, when it's all said and done, we will spend about $17,000. So about $1,000 less, almost $1,000 less, because someone's giving you $930 to do this cash secured put. So this is an excellent way to jump into Tesla and still have some type of cushion for it to continue to fall, but with the premise that it has some support around the 180. Now, if you had to take ownership of the shares, you can do the next step of what is commonly called the wheel strategy. At the Dorian Trader, we call the four strategies that we're talking about, we lump it together and call it the safeguard strategy. But it's a popular strategy out there. A bunch of books have been written on it called the wheel strategy. We believe at the Dorian Trader that the safeguard strategy is an improvement on the wheel strategy. But the cash secured put is a part of the wheel strategy, and the covered call is a part of the wheel strategy. So if you sell that cash secured put and you have to take ownership of the shares, then at that point you can become the landlord and you can rent out your shares. You can set contracts with people or sign contracts with people to rent to own. They have the ability to rent to own your shares, right? So they're paying you a certain amount depending on the expiration period every month or every week or every quarter or every year, depending on how you have it set up. In this example here, we're doing 49 days. So someone will pay you some monies to rent your shares, but have the ability to rent to own your shares. So if you do a covered call that looks something like this, you will have 100 shares, and then you can sell a call against it. So if your call spaces was, let's just say your call spaces was 171, 170, you can sell something at this point at, let's just say, almost at the money at this 83, this 183.33, and someone's going to pay you about $1,100, just over $1,100 for that. So that would lower your call spaces even more by selling somewhat of an aggressive covered call, because you're selling it at the money. If you want to be more aggressive, you can sell it at around your call spaces. So your call space is around 170, just under 171. So you can sell your call at the 170, and that's going to give you some, that'll give you some premium. In this case, $600 in premium, and that'll give you another basically $600 to the downside for Tesla to continue to fall before you start losing, before you start going below your call spaces. But in this example, if you want to go even thinking Tesla's going to bounce back up, you can sell something like the 185. That's going to give you $1,100, plus you will have the ability to gain between the 183.25 to the 185. So you'll get a little bit more capital. So in this case, you'll make a max profit at about 12.20 if it jumps up. Okay, so this is the covered call. You can be aggressive by selling it in the money or at the money, or you can be a little less aggressive and selling more out of the money, which is traditional what people do. If you believe Tesla's going to jump back up a lot, so I say back to 200, you can put this outside of the 200 mark and put it at the 205. You're not going to collect as much, but you can have the ability to make more if it does jump up to that. You can see here you can make over $2,500 there on this covered call if it jumps up, but you're going to have less protection to the downside if it doesn't jump up, if it continues to fall. So it's trade-offs in that scenario. So the next strategy we want to discuss is a collar strategy. A collar is when you take some of the monies that you receive for selling a covered call and you buy a put. So for example purposes, I just say you had 100 shares and you sold a call against it. Well, if you sell a call and let's say you receive about $1,100 here, then you can take some of those monies and you can buy a put to kind of offset the downside. So in this case, let's say we bought a put at the 170. Well, this will limit our loss to the downside. Okay? If we did something like this will limit our loss to the downside, because we can sell this call, and then that's bearish, and then we buy this put, then that's bearish. We will have 100 shares, so we can still have some risk to the downside, but it will be stopped once it hits the long put that you buy. This strategy is called a collar strategy. Okay? It's called a collar strategy. This can protect you for the downside. So if you're having a stock that's falling a lot and you have a bunch of shares from it, you can collar it off to protect yourself from it falling more. And then you can set it up that you can get some upside again if it jumps back up. So for example purposes, if this was Tesla and you had 500 shares or whatever the case may be, you think it's going back to 200, but you're afraid it's going to fall some more. So you can sell this call and collect about 550, and then you can buy a put that's cheaper than that. So if you bought a put here, then you're going to get a credit of about 77 cents, and then you would stop losing if it falls below the 166.67 here. So you can set yourself up to feel a little bit more comfortable if Tesla keeps falling, and if it jumps back up, you can get all the premium from your shares all the way up to 200. So this collar strategy can be a powerful strategy to help you when the stock is going down a lot, to kind of just minimize that downside. And the fourth strategy that we want to talk about is what we call the Bionic bull. It's selling a cash secured put, so you have to be willing to take ownership on all these four strategies that we've been discussing. You have to be willing to take ownership. When you sell the cash secured put, you have to be willing to take ownership. When you're doing a covered call, you already have ownership. When you're doing a collar, you already have ownership. And so if you're going to do the Bionic bull, then you have to be willing to take ownership. So I just say you love Tesla once again, and the premises is that it's going to have some support, or it has some support at the 180. You think it's going to jump back up to, let's say, about 200. So, and you want to benefit from all of that, but you want to do it for less than just buying the shares at the current price. So what you can do is sell the 180 put, and then you can buy a call that's cheaper than that. So for example purposes, if you wanted to buy the call at the 191, then you can definitely do that at this point, right? You can have unlimited upside over the next 49 days if you did this. And so in this example, you're going to get 84 deltas. That's basically like having 84 shares. And this is not static, meaning it's not going to stay the same. It's dynamic. So this could go up, and you can wind up having more than 100 shares, depending on how this plays out. But this is a way you can have a lower cost basis than what it's currently trading at. So it's currently trading at 183.25. Your cost basis can be 178, just under 179. Right? So you have about a $4 cushion for Tesla to continue to fall. So a $4-6 cushion for Tesla to continue to fall. So you want to keep that in mind. This is the benefit of this trade. Plus you get all the upside of Tesla going up. And someone's going to pay you a credit for that, for this Bionic bull type of strategy, as you can see here. So I want to kind of show you how this Bionic bull looks on a curve view. So if you go here, you can see this is the at the money. If it goes up, you have unlimited ability to the upside. And if it drops, you still have a decent amount of chance of when it has to fall about $4 to $6 before you start losing your cost basis there. So this is a way you can play Tesla to the upside, and you can use these four different strategies. They're all bullish strategies. So don't be mistaken. You do want these things to go up. Even though the collar strategy, as we talked about, can minimize your downside more, it's still a bullish strategy. But this is how you can use these four different strategies, what we call the safeguard strategy at the Dorian Trader, to really enhance your stock buying. All the stocks that you have, if you have at least 100 shares, you can do this, and you can use this strategy. Or this can be your primary strategy to purchase 100 shares or more of some stock or some company shares. You want to keep in mind, you want 100 shares, and you want that as in lots. So a standard lot in the stock market world is 100. So you want to do this. If you want to buy 100 shares and then buy another 200 shares, another 300 shares, and then you can do this strategy, all four of these strategies, if that's the case. Okay. All right, so this is what we wanted to cover in this video. We encourage you to leave comments. We answer all comments. We encourage you to like the video and share it with friends and family if you can. And we will see you in the next video. Thanks for watching. Bye for now.